Hi, this is Courtney Carroll. Welcome to Mortgages with Courtney. As we pivot and we start to move out of COVID crisis and we start to look at opening up our economy, we have statistical evidence that shows the majority of Canadians still want to own their own home. That is a desire of many, many Canadians. But simply wanting to own your own home does not get you there, especially in today's market with prices being as high as they are. Wanting to own something is not the same as having a plan and taking decisive actions to get there. Today in this video, what I'm going to do is I'm going to share with you, would-be home purchasers, the steps you need to take in order to make your dreams a reality when it comes to home ownership. And they're really simple steps that you need to take if you are serious about owning real estate in the Canadian market. Before we get into that, I want to remind you to like, share, and subscribe to this channel in order for it to grow. The purpose behind this channel and why it was created is to make sure this information gets into the hands of those who could benefit from it. So let's dive right into this. The first thing that we need to understand when it comes to home ownership, you cannot get a home by accident. You must start with a plan and you must start early. Individuals who own their own homes, whether it's their primary home or they've got investments, have always had a plan for how they're going to get there. And so that's the first tip. Tip number one is have a plan and begin early. So what do we mean by beginning early? Let's assume that you are a young couple, you've been in the workforce for a couple of years and you're thinking about starting a family or not. You're simply thinking about having your first home. Well, it doesn't happen overnight. And this is what we mean by having a plan. So maybe it's 3 years down the road that you need to get your finances in order, get your credit in order, and save for your down payment. So having a window of time, knowing that 3 years from now, I need to do some things along the way to get to where I need to be in order to make that purchase is what we mean by having a plan. Nothing happens by accident. If you're looking to buy real estate in any market, you must start with a plan. So that's step number one. The second step that you must keep in mind is you need to think about what kind of property do you want? Are you looking for a condo? Are you looking for a townhouse? Are you looking for a single family home? What is the purchase price of that asset that you're looking for? And also, where do you think you can afford it? Buying a property in the GTA is very, very costly right now. And so as a young couple coming out, maybe as a single individual, you've got to start looking at, is that realistic for you? Or do you have to make some changes to the location that you purchased? Now, the next piece in this is to assess where you are financially. So we have three things now. This is the third point. Point number one, have a plan. Take action, but make sure you have a plan. Number two, determine the type of home, cost, where you want to live. Number three, assess your financial abilities. Where are you when it comes to income? Are you gainfully employed? Are you working a full-time job? Is it a salary job? Are you working contract, right? Is that contract for a couple of years? Are you just doing part-time piecemeal here and there? Will that income sustain you for what it is you want to do? Or do you have to upgrade your skills to get a more solid source of income? Do you need to do a side hustle? Side hustles are basically taking on additional income or additional work to supplement your income, so you have a larger, income for qualifying, right? So these are some of the things that you have to assess. You need to assess what your financial abilities are. If it's you by yourself, it's easy to do. Am I fully employed? Is a salaried, employment that can be supported by a pay stub, can be supported by a job letter? Is it a contract? Am I under probation? All those things, right? Am I new to this field? Is this a field that's growing? Will I have this job 3-4 years from now? Or do I need to start planning something else and exit this so when I do come 3 years into the future to buy my property, I'm not saddled with this uncertainty of where I'm going to get my income from to qualify for a mortgage. So this is a really important piece. You need to assess where you are when it comes to your income and your ability to afford a mortgage. And if you find that your income is low, this is a perfect opportunity right now to get a part-time gig for a couple of years. You don't have to do it for life. but this is a way to supplement your income by doing something on the side to help elevate your purchasing power and also your down payment. Okay, so that's number 3. I kind of made reference to number 4, so let's start now with number 4. Number 4 is very important. This is, you need to begin the savings process as early as possible. Once you've got that plan in place, once you've visualized where you want to live, once you've assessed your income, you need to start thinking, how much can I put aside on a monthly basis towards the down payment that will be needed to get me into the mortgage? And whether it's putting 10% of your pay towards the down payment over the course of several years and coming up with at least 5% for a high ratio mortgage, that's great. The larger the down payment you put, the less mortgage you have to borrow from the bank, which means the less costly will be for the life of the loan. So having a sizable down payment helps with the total borrowing cost that you will have to pay back to the bank. So where do I put that money? Do I put that money into a savings account with TD at less than 0.25%, or do I put it in an investment? Maybe I'm putting that into my RSP, looking at getting some dividend stocks that will pay me for buying those stocks over time. Again, I'm not going to be speaking to what you put your money in as far as stocks, but make sure it's in an asset that's going to grow, at the same time give you some safety. And you can do that in an RSP, you can do that in a TSFA. We've got vehicles for you to save your money, more so than just simply leaving it into the bank, or worse, putting it under your mattress. So that piece is important. Where's your down payment coming from? Do I need to go to mom and dad, the bank of mom and dad? Some of us are fortunate to have that. So if you have parents that are willing to gift you the down payment, or give you a nice loan, that's great. That's part of what you can put into your plan, that you're going to get your down payment from a family member. That is great to have those pieces well ahead of time, so 3 years from now where that source of down payment is coming from. There's only a couple more pieces, so let's dive into point number 5. This is so important, and I want to share this with you guys because as a mortgage agent and someone that was in the financial service field for a while, giving life insurance and mutual funds, this piece is so important, and so many people get it messed up. This 5th step is to protect and to build your credit. I can't tell you how many people I speak with that just don't get this. We're talking adult Canadians who are in such deplorable states when it comes to their credit. I don't get it. Do not be one of those individuals. Protect and build your credit. If you know your plan is 3 years down the road, you've got plenty of time to fix whatever errors you've had in your ways. So what do I mean by protecting and building? I want to make sure that you have 3 trade lines. What do we mean by 3 trade lines? 3 trade lines means you've got 3 revolving credit sources or installment sources. So you may have a student loan if you're young, coming out of work, coming out of schooling, you may have a student loan, and that's fine. You may have a credit card. If you only have 1 credit card, I would suggest you get 2. All right, and you want to use those credit sources on a regular basis. Maybe you use one to purchase your gas, maybe you use one to purchase your meals, but when you get the bills, you are paying them off. Do not let debt accumulate, especially if your long-term goal is to purchase a property. You want to show that you're constantly using credit, but that you're responsible with credit, that you're not missing payments, okay? That you're not going in debt beyond your means. This is really important to the credit sources or the credit lenders out there, that you are good with credit, that you can manage your credit, and that you're not taking on more debt than you need. Your credit ratios are in line. If you have a credit card and the balance on your credit card is $2,000, but your available credit is $10,000 on that card, that's a 20% usage rate, and that's okay. You want to keep your credit utilization to less than 35% for each card you own. So if you've got 2 credit cards and you've got $5,000 on one and you've got $10,000 on other, $1,000 on the $5,000 card, that's fine. That's a balance. $2,000 on the $10,000 card, that's fine. That's 20%. you are golden. Where you get into trouble is when you have high credit utilization. So I've got that $10,000 card, but it's maxed out at $9,000. That is a high credit utilization, and it's not seen as favorable on your credit. So we want to make sure you're protecting your credit at all costs. You can't go far when it comes to our consumer-oriented society as far as buying assets, building wealth, if your credit score is jacked up. I can tell you that straight up. I've worked with a lot of families, and what stops them from getting into their purchase and their dreams is their credit is unworthy, and lenders will not deal with them. So credit protection and building is very important. So here's the next thing, and this one really gets me. I've worked so hard and so often with individuals wanting to do the very best by them to get them into a mortgage, to get them qualified with a lender. But what stops many individuals is this cardinal sin of buying liabilities before they have the assets in place. If your goal is to purchase real estate, then you have to delay any kind of gratification when it comes to toys and new furniture. By toys, I've worked with individuals who say their goal is to buy a property. They've come to me looking for a mortgage, but they've just recently purchased a brand new automobile at the financing cost of $700-800 per month. What this does is it pushes your ratios, GDS and TDS, I've spoken about that earlier, out of range, and they can't qualify for the mortgage that they want, especially not when it comes to a high ratio mortgage. So we have to learn to delay our gratification when it comes to wanting liabilities such as cars. I know cars are beautiful, but that new car smell that we covet goes away very shortly. Your asset, that home that you want for your family, that to grow your wealth and to build a solid foundation for your financial future, that is something that's going to be there year after year after year. Once you've got that in place, then it's okay to start looking at some of those wants that you've had and purchase those liabilities. So maybe after you've owned the home and you've got that asset building and you've got some equity build up, maybe then you can treat yourself to a new car. But again, within reason, because we always want to be mindful of our credit utilization, and making sure that we protect it at all costs. Having your home doesn't mean you miss and you start making errors in your judgment about how you manage your credit. Most individuals, their first home is not their final destination. It's what we call a starter home. And so we want to get you into the market, but it doesn't mean that first home is going to be your final destination. And so let's say 5 years down the road, you've outgrown the home, you've got a couple of kids now, you need a bigger space, but you've bought all these liabilities along the way, only to find out that you can't trade up to a bigger house because your ratios don't work, or your credit score has been derogatory, or dropped down to an area where the banks just aren't willing to lend, or they're going to lend to you at a premium. This is why the steps I'm going over tonight are so important for would-be homeowners to understand, and even those individuals who already have a home. Protecting your credit, understanding assets versus liabilities, making sure you're never putting yourself in a position where you're overextending yourself when it comes to debt is so important for your financial future. The last piece before I go into the recapping for you is this. If you are considering a mortgage, if you've got the plan in place and you're looking 2-3 years down the road, even a year out, you want to take the next step, which is to consult with a mortgage broker. Now, the information you're going to get from a mortgage broker is much different than what you're going to get from the banks. The mortgage broker will guide you through the steps, as I'm doing right now. I will make sure I'm working with you to talk about what debts you've got, what your future income potential might be, what you need to do to fix your credit and so forth, what debts you need to pay off first based on the ratios, and what would work best when it comes to getting a mortgage. So the mortgage broker has all those pieces that they can work with a client on to make sure that when it comes time 2 years down the road, you are set. You are basically ready to step into a mortgage and get that approval that you want. So these are the steps that I've gone over. I'm going to go through them. There's 7 in total. So again, The first one, and probably the most important one, is you must start with a plan. As we said, you cannot hit a target that you can't see, and you can't hit a target without action. So start with a plan in mind. How long into the future are you thinking, and go from there. Second is, what kind of home do you want to see yourself in? What's the purchase price? What geographical area do you think you can afford? And understand that that may have to be adjusted based on your earning potential, your down payment source, your credit scores, and so forth. Assess where you are financially. What do I need to do differently? Is my work enough for me to get what I want for my family and for myself, or do I need to upgrade? Do I need to leave this job and retool to get a higher paying job? Do I need to find myself with additional sources of income, doing a side hustle so I can afford the house that I want to, especially if it's just getting into the market? Number 4, save immediately. And we've always talked about, and you've probably heard it in the financial field, save 10% of all you earn should first go to you. The Richest Man in Babylon is a wonderful book to read about the importance of saving. But if you're looking about putting money away for real estate, it might be more than 10%, and you have to make some sacrifices and go through the hard times to get into the asset that you want. So make sure you start the saving process as quickly as possible when it comes to the down payment. And if you got the the fortunes of having a family members, whether it's parents, grandparents, to gift you the down payment, that's a blessing to you. Number 5, build and protect your credit. Goes without saying, without credit, there's not much you can do. Have at least 3 trade lines. It could be 3 credit cards, but make sure you're using those, building your credit. Do not take on more than you can chew. Pay your bills on time. Do not miss payments. That is how we build our credit. Avoid buying liabilities. That wonderful trip that you want to take, that 10-day trip around the world or 20-day trip around the world, that fancy new car to impress your neighbors and to impress your coworkers. These are things that you want to do and delay for as long as you can. Buy the assets first before you get into the liabilities and your wish list. Next one is to consult with a mortgage broker like myself. I'm here to assist you to get you into your mortgage. If you've got a mortgage, great. Make sure you're protecting your credit, because when it comes to refinancing and getting something bigger or consolidating your debts, those things are going to be in play again. We're going to be looking at your income. We're going to be looking at your credit scores. All those things don't go away. Lenders want to know whether you have a house or not. What are you like as a client when it comes to debt management and so forth? So those are the keys for those who are looking to get into the market. If you've not gotten into the market yet, it's a wonderful place to be. It's the place where you can build a financial foundation for your family, where you can start looking at forced savings for your financial future and your retirement, and also being able to pass things on generation to generation when it comes to wealth transfer. So again, I ask you guys, if you like the content here, to please like, subscribe, and share this video with as many people as possible. I want to reach as many people as possible, not just from the content of the video, but I'm here to really help individuals when it comes to mortgage financing, whether it's a refinancing, whether it's a new purchase, and so forth. Make sure you reach out to me if you're looking to switch, if you've got a renewal coming up. This is why I'm here. But most importantly, I want to make sure that I am doing what is right ethically always for my clients, providing service before self always. Thank you guys for tuning in tonight to this wonderful conversation. I hope you found value in it. Again, please like, share, and subscribe. Courtney Carroll, Mortgages with Courtney. We'll see you on the next side with an upcoming video for you.